Warren Buffett once said, "If you want to be rich, you must find a way to make money in your sleep." And in this century, under 30 millionaires spring from many parts of the world, so it's hard to imagine how. How do intelligent investors beat the curve? How on earth is it possible to make so much money without effort? Join us as we discuss in today's video the power of passive income. Let's have a case study of the most typical example. A young man fresh out of college, knee-deep in debt, with a 35-year career ahead of him. Let's call him Michael Clark. Young Mike, like his father, has an engineering degree and is looking forward to starting off with an amazing salary so he can clear his student debt and live a comfortable life. Mike secured a great job at Ford, where he was being paid $150,000. He's enjoying a great start. The economy was great. Young men like him with such skill and ability were hitting it big in the industry. Life was good until it wasn't. An economic crunch inevitably came around and Ford had to lay workers off. After several rounds of firing, Michael Clark loses his job, and that was when the reality of his predicament dawned on him. These are the cycles of life, and they don't teach you in school how to make the most of both phases of life, let alone to be a savvy investor. One day, Mike stumbled over a copy of The Richest Man in Babylon. The backside of The Richest Man in Babylon read, "An assured road to happiness and prosperity." Maybe this was just what he needed. Mike borrowed the book. Surely there must be something in here that should be useful. And boy, was he correct. There was one rule that stuck in Mike's mind: pay yourself first. The book advocated that Mike should pay himself 10% of his salary each month before doing anything else with his money. How could he do that? He has a huge pile of debt to clear, bills to pay, and other recurrent expenses that are essential to life. So how could he obey that principle? It's one of the ways intelligent people make money without effort. They make such sacrifices. Without any former investing experience though, he soon found himself reading speculative tips on various listed companies. It started off very well, with high initial returns. $2,000 became $5,000 in just a week. Call it beginner's luck, but not for long. The little capital he had rapidly declined by 60%. Now, another Warren Buffett quote would come in handy. Rule 1, never lose money. Rule 2, never forget Rule 1. For Mike not to lose money, he has to curb his greed and learn a lot about how the market works. Michael Clark knew he had to become a learning machine. He had been saving in his time with Ford, but has lost over half of all he had in foolish trades. Now he is determined to make things right. Mike paid thousands of dollars for trading courses, spent a good number of hours every week studying trades and how to make the most of every opportunity. He even opted for direct mentorship, and I'm sure he would have also liked, shared, and subscribed to our YouTube channel, just as you should too. The net gains were coming in slowly, but he persevered. He didn't know anything about Charlie Munger yet, but Munger would say the first rule of compounding is to never interrupt it unnecessarily. By the time Mike was 27, he was already a whiz at stock market company analysis. He did not try to make any brilliant or advanced investments, but instead followed Buffett's mantra: "I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over." But one day, Mike's phone rang. It was Marshall, the top of the class from Mike's high school, who had moved on to graduate with a major in finance from Harvard. Marshall just bumped into an amazing investment opportunity, a startup, the Walmart of the metaverse. He is confident they will make a lot of money taking the company public. Marshall was willing to stake 50 grand, but you have to understand that Mike was quite reluctant to jump into a deal like that. But Mike trusted Marshall, even looked up to him when it came to finance. And this seemed out of line with what people who had proven long-term success in the market advocated. Would Peter Lynch have jumped on the investment? Lynch would say, go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it. It took blood, sweat, and toil for Mike to raise his first $100,000, and he's not about to throw it away like it cost him nothing. Like Charlie Munger says, do all you can to save your first $100,000. Mike had a fire in his gut because his investments were growing like a snowball rolling downhill, gaining momentum as it goes, all thanks to the power of compound interest. So he decided to invest $500, but the call Mike got from Marshall was 12 years ago now, and it had been all forgotten. Marshall's $50,000 had now become $1.25 million. That's what you can reap from a lazy portfolio. It's a collection of investments that need little maintenance. A lazy portfolio is a typical passive investment technique for individuals who have time horizons larger than 10 years. And it's called lazy because you don't actively manage your portfolio. It is referred to as the buy and hold investing approach. This is how investors would attain long-term financial independence. Just like Mike's friend hit it big, exchange-traded funds that are passively managed can be used as lazy portfolios. Lazy portfolios generally have two features: lower fees and lower risk. The fees are lower because they aren't run by overpaid fund managers, as in many expensive mutual funds. That's because you are investing in the entire market rather than selecting individual stocks. ETFs and low-cost index funds are far less volatile because they invest in the entire market, so the risk is lower due to diversification. What are the types of lazy portfolios that exist? There's the one fund and two fund portfolio. One fund portfolio is a lazy portfolio that invests in the entire US stock market. Using just one ETF, you'll gain exposure to the US market with this very basic lazy portfolio. For instance, an investment of $1,000 in January 1972 would give you $105,000 in September 2018. That's the kind of ROI even Marshall and Mike would be envious of. As for the two-fund portfolio, it includes two ETFs, one holding equities and the other bonds, 60% US stocks and 40% US bonds. You will have access to a variety of high-quality equities and bonds with this straightforward lazy portfolio. That's right. Did you know a $1,000 investment made in January 1987 increased to over $14,000 in January 2019? You're welcome. Just like Marshall, Mike's $500 also enjoyed the same 24 times returns, but to a meager $12,500. If you play big, you win big, but you also lose big. So it's a risk you must be willing to take. In a world where people typically lose money in the markets, lazy portfolio results may seem appealing, but there's good news and bad news. The good news is that you can achieve the gains you see with a straightforward asset allocation using ETFs. The bad news is that if you don't know precisely which portfolio is appropriate for you and don't stick to your investment plan, making the money you expect might not be as simple. Mike just learned a life lesson from that investment and has become a better investor. Fear, uncertainty, and doubt no longer have control over his decisions. He is now a more rational investor, but it is his ability to make money in his sleep that has earned him his financial freedom. Mike Clark made the most of passive income to boost his earnings. To retire early, this saved him 14 years of work. He now hosts seminars and conferences, plays golf, and teaches his daughter to ride her bike. Mike now has all the time in the world to himself, goes wherever he pleases, and works whenever he likes. He is an ever-present husband, dad, and tutor, all thanks to the power of passive income. So, how can you leverage the power of the lazy portfolio to boost your earnings? You must pick the most suitable lazy portfolio for you. Consider your investment's time horizon while choosing to adhere to the lazy portfolio's asset allocation. Lazy portfolios are composed of diverse assets that can perform differently depending on the stage of the market, while high-risk portfolios may not be sufficient to protect money in the long run. If you wish to put your lazy portfolio into practice, you can buy the ETFs of your choice and adhere to their asset allocation. Make sure you select ETFs that replicate the appropriate indices. For instance, you will be exposed to currency risk if you replicate foreign or worldwide indices, such as stocks from emerging markets or from Europe. If your currency differs from the US dollar in this situation, your investment would be in danger due to currency fluctuations. Thanks for watching this video. Don't forget to like, share, and subscribe to our YouTube channel for more amazing videos. Stay tuned.